Leveraged real estate. Just listen to my man Graham Stephen. Man, he talked about leveraged real estate, making sure cash flows and all. I'm just like, man, these people weren't around 10 years ago. Well, more than 10 years ago now. That scares the hell out of me, man. That scares the hell out of me hearing this. Yeah. Leverage is the kiss of death, my friends. Leverage always works on paper. Always works on paper. And it always bankrupts people. Doesn't mean it always bankrupts everybody, but civilizations have been lost because of leverage. Debt is what it is. Let's not confuse leverage with debt. I'll tell you Sarah's story with you. It sits in my mind like you wouldn't believe, because it was a big deal. A lady from Louisiana called me. This was when I first started at USAA, 2008, and her mom had recently died. Mom was a pretty hoity-toity, well-to-do real estate attorney in Miami, and she had all these condos. She had leverage to the hilt, and it was great. Then kaboom, and they cash flowed. They did. She had occupants because they couldn't afford to buy their own condos in Miami. She had cash flow. She had occupants. People paying on time. What happened when the job market dried up? These people couldn't pay. So might have cash flowed now, but when the people lost their jobs, they were put out. They had to move in with their mom. They had to move in with grandma. They were late on their payments. That was in 2006. And that was before the market started tumbling for the values. So she has all this debt she's carrying, we'll just say on $250,000 a pop condos, which cash flowed out without question. The bank lent it to her. I think she was putting 10% equity in. I think that's all she had. That 10% equity disappeared like that. So just like my man Joe, the car wash guy, and he had a performing loan. His loan was performing. He was cash flow positive like a crazy man. Bank called that loan. This lady had 7, 8, might have been more than that, condos in Miami. No equity because of mark to market. And that, look, mark to market, it sounds like that stuff is behind us. It's not behind us, man. The bank, any bank. Look, I used to be a banker. We put 1, 2, 1, 3, and 5 year terms on the loan that we could revisit it to see where you stood. So the bank's gonna say, look, 2006, all right, the market hasn't really fallen off that much, but she knew her cash flow was drying up. She had to dip into her savings. Remember, this is a freaking highfalutin, bigwig real estate attorney. She's making like $500,000 a year. Her daughter told me. So in 2006, she was tipping into her cash flow to make payments on these condo loans, which weren't cash flowing anymore, even though they were when she took out the debts, because the people lost their jobs. Just because it cash flows now doesn't mean it's going to. This is nuts to me. And so she had leverage like crazy, debt. You know, freaking, she started 90% loan to value, 10% equity. And people are like, oh, they're giving money to anybody. She was a good risk. She was making money. The condos cash flowed easily. She was a good credit risk, and she put 10% equity down. I mean, you think 20% would have solved this? No. So the banks were eager to loan her money because she was a good credit risk. Highfalutin attorney in the business of real estate. Had positive cash flow, huge amounts of income. And again, you can't look at net worth in terms of how much you have in her IRA and stuff because it's irrelevant. Bank can't attach that in a bankruptcy proceeding. But she still had $1 million of liquid net worth or whatever it was. And the bank said, no, yeah, you're a good risk. We're going to loan this to you. And just like that, her 10% equity fell. Just like that, the price, when she lost her tenants or they were delinquent, just like that, she couldn't find people to get in those homes to keep up with the payments that she needed to make the payments to the bank. Just like that, she had to dip into her own accounts essentially wiping out all of our equity or all of our liquidity. And just like that, the bank said after a year or two, because banks aren't stupid, my friends, they put these structures on the loan so they can revisit it. Usually what you do is once a year, you'd have to revisit your portfolio. Usually it's a pretty cut and dry check-in. Hey, how's business? Let me look at your cash flow statement. Let me look at your 1040s. And you look at all that. Usually it's just a cursory look. You just make sure that everything looks hunky-dory to what it looked like before when you loaned the money to the business. And if it did, you're like, all right, you're good. We'll revisit you in another year. You think the banks aren't doing the same thing today? Looking at your business and saying, hey, I see you got 4 or 5 rental properties out there. Yeah, that's a risk, because the risk is always to the bank on a rental property, never on your owner-occupied property. It's always on the rental property. That's the first thing you're going to let go into delinquency, and the first thing you're going to walk away from. Banks know this. And hearing people like Graham scares me to death, man. It's just the flippancy. And I like Graham. I freaking follow his YouTube channel all the time. But that just scares me to death, because the cash flow today does not mean cash flow tomorrow. And if you got leverage on that, even if you got 20% equity, 20% equity, man, the market falls, you're doomed. You're done. Bank calls in that loan. What do? Well, just like happened in 2008, you and everybody else in the neighborhood start selling that property. Huge supply, and there's an exhausted demand, because the demand is for people who can afford it. And unless you're a cash flow, you got tons of cash on the side. I share this story about my house in Phoenix. Bought it in 1998, Charlotte and I think about $100,000, something like that. And we didn't put any equity into it. I didn't even use my VA loan because the VA loan had higher interest rates. And on top of that, we had something called sweat equity. So as long as we painted the interior and the exterior of the home, Charlotte and I, that was kind of like our down payment. Trend Homes was a builder. And we bought it in 1998. We sold it when we moved back to Virginia 3 years later, something like that, 4 years later, for $125, I think. Lady who bought it from us sold it in 2006 for like $250. We went back out there in 2011, and it was on the market for $74,000, or had just been sold for $74,000, something like that. And we were driving by, and I saw the door was open. I said, man, because we were on vacation, hadn't been to Phoenix since for 10 years previous. So it was 2011, 2012 maybe, because when the Blackhawks were playing the Coyotes in the playoffs. It was 2011. I can't remember. But anyway, one of those years. We go back 2012. We go back, and the door was open in our house, 905 East Monona Drive, Phoenix, Arizona, 85024. Something like that. And there's a guy in there, and I said, hey, I just knocked in. I said, hey, I used to own this house. I was the guy who bought it when they first built it. He goes, oh, man, come on in. I said, oh, it looks exactly the same. Small, 3-bed, 2-bath, 1,200 square foot, completely gutted. I said, what happened? He goes, yeah, man. And this turned out to be an orthopedic surgeon, and he was buying up all these properties with cash money. That's what it was. He paid $75,000 for cash. That's what it did, because it was in foreclosed. It had been foreclosed, and the bank was trying to get rid of it. I said, man, that's a steal, because we paid $100,000 for it, basically 15 years before. He goes, yeah, man. I said, well, what happened? He goes, the previous occupants took all the copper wiring and all that stuff out. So they just skedaddled, and they took all the stuff. The dishwasher was gone. They stole from this guy. It wasn't him. He didn't own it, but they stole, and they just let the bank deal with it. So the bank sold it to this orthopedic surgeon for a dime. And he was like having his little kingdom of houses right there in that North Phoenix area, because he was making cash money for it, because he had cash. And he wasn't leveraging it. Now, if he leveraged it, that would have been a great investment, because the leverage can work like a charm when the markets go in your favor. Way too many things that go against it in real estate leverage, though. Way too many things. Graham is just talking about interest rates. Nah, so much above that. What if your tenant cannot maintain the cash flow to afford his payment? What do? You're going to reduce the terms, you can reduce the rate. All right, well, you still owe the bank X. The bank doesn't care. Bank says you pay or we're taking it over. And trust me, the banks aren't in the business to take over your stupid house. But they're also not in the business to let a loan go delinquent. Trust me. Having been in banking and seeing what these guys say, you look at your portfolio every month. What do you got delinquent? What do you got outstanding? What are you working on? And why, if it's delinquent, why is that loan delinquent? And bankers have lost their jobs for having too many delinquent loans, because it shows that you didn't underwrite it well, or you didn't need to know how to read the cash, the balance sheet, or the 1040. And they put you through some serious education on how to read a tax return, which is why I got into taxes, because I loved it. I loved the idea of adding back interest to cash flow. I loved all that stuff, amortization, adding that back to cash flow. You don't just look at the bottom line of a 1040 in a business, because a business has all these write-offs, but it doesn't affect cash flow, but it affects its taxes. Two different times of statements, one for the IRS and one for the business operations. The IRS is what you pay tax on. The business operations are cash flow. The cash flow is a real one. The IRS is just your accounting stuff, which is legal. But that's not what you operate to run credit or to look for a loan opportunity for a business. You look at what the cash flow statement is. Or you look at the 1040 and add stuff back like amortization, debt interest payment, all that stuff too. Anyway, long story short, you're leveraged, interest rates go up for whatever reason, banks aren't lending money, job closes, Trump trade war is closing everybody, we're all in this huge recession, people lose their jobs, oh no. Yeah, interest rates don't matter then. It's kind of like going back to the recession of Japan. Low interest rates matter or not. If there's no lenders, no borrowers, it doesn't matter what the lenders are doing. And you, as a real estate titan, are just saying, man, interest rates are low, that's great. No, you're not saying that. You're saying, I need to get a tenant in this place. And I need that tenant to pay the equivalent of $1,500 a month in payment so I can afford the debt I got on this property. Well, guess what? Now you got 100% loan to value, if not negative equity, because the prices just dropped, because there's no one can sell those properties. So now you're sitting there thinking, phew, I can't liquidate this place. No one's going to pay $1,500 a month for this, because my next door neighbor has a condo for sale or for rent for $800 a month, and they're basically identical items. So if someone's going to come here and rent for $1,500, why would they do that? They just say, no, I rent over there for $800. So I got to drop my rent. The bank says, sucks to be you. You still owe us $1,500 a month. Anyway, so what happened to this real estate lady, attorney in Miami, is she had a heart attack and it killed her. Now the daughter didn't say is 100% attributable to the stress factor she had on all these debts coming due, because they were fast and furious. She was way underwater and everything. Job market dried up. She was in a world of hurt. To be perfectly honest, I'm not sure she didn't kill herself, to be honest with you. Heaven forbid. But, if you're a highfalutin lady, real estate, making big money, lawyer, and all of a sudden you got a pot to pee in, that could be pretty dramatic for sure. It's weird how they talk about that in the Bible. Easier to get for a camel to get through an eye of a needle than for a rich man to get in heaven. Because pride, man, pride. All right, so she was leveraged to the hilt. Real estate market fell. So the executrix was her daughter, who was also a successor trustee, because this lady was a real estate attorney, knew how to put various properties into a living trust, an LLC. Long story short, the daughter said, look, what do I do? I mean, I owe, or not me, but her estate owes well more per unit than what I could get. This is the latter part of 2008. I said, well, you're not liable. You didn't sign for them, did you? She goes, no. I said, thank goodness. Because if you would have signed for it, that would have been bad. I said, you're just going to have to walk away. She goes, really? I said, what else are you going to do? She goes, my mom, she has nothing. Nothing. And, she was 65-year-old, something like that, 60s, high-falutin corporate attorney. I said, that's just, unless you can come up with the cash flow to make these payments and wait for the market to come back around. And she goes, I'm from Louisiana. Can't do that. Hey. So she had to walk away. I'm sure those condos now are trading at a heavy premium to what they sold them for when the bank foreclosed. I imagine they sat there unoccupied for a couple of years, just like my house in Phoenix. I imagine somebody took a risk with cash money to take those foreclosed properties off the banks. I bet they didn't take a heavy leverage on that. Regardless of interest rates being low, I bet they bought those cash money because they say, I'm not messing with that, man. Because if it can cash flow now, that doesn't mean it'll cash flow in the future. If it can't cash flow in the future, I don't want to lose my life savings to that. Now, the funny thing is, part of my expression, because it's not funny, we've seen this time and time again throughout history. Leverage makes kingdoms fall to their knees. Don't let it happen to you. Don't let it happen to you. I don't care what the opportunity exists because of low interest rates. That means nothing. I don't care if the opportunity exists because of positive cash flow. That means nothing. That's a snapshot today on a 30 to 15 year commitment. Don't let it happen to you. If you can't pay cash other than your primary residence, don't do it. Your primary residence, I get it, because you are occupying that and you need a place to live. I get that. If you can't pay cash, I'm telling you, man, don't do it. All right, we'll see you.